So I want to talk about three views of the world. I'll be brief. The first is Jay Powell's view. What is Powell's plan? What is Jay Powell doing? The second perspective is, what does the market think is going to happen? The market doesn't necessarily have to agree with Powell. And then the third thing is, what's really happening? That's the most important, because the market has it wrong too. So we'll do the Powell plan, the market view, and what's really going on. So Powell's plan is clear because he's told us 5 times. He's starting to worry that no one's listening, but he gave speeches August 26th in Jackson Hole, September 21st in Washington, D.C., November 2nd, again in Washington, D.C. at an FOMC meeting, November 30th at the Brookings Institution, and again on December 14th at an FOMC meeting in Washington. So that's 5 speeches. And he said the same thing all 5 times. He said inflation is job one. It's not that we don't care, but unemployment is going to go up. We're going to have a recession. He doesn't use the R word, by the way, but it's implicit in everything he says. We are going to have a recession. Unemployment is going up. And too bad. It's kind of too bad, because we got to get inflation under control. And so the Fed is in search of something that they call the terminal rate. What's the terminal rate? The terminal rate is a rate that's high enough to bring inflation down on its own without further hikes. So it doesn't have to be higher than inflation. It has to be high enough to cause inflation to come down to the Fed's goal of 2% without hiking more. And when they get there to that terminal rate, they'll sit tight. They call it the pause. The pause could be a year. And Powell said this, again, this is right out of his script, to mid-2024 perhaps, before they actually cut rates. So Powell's in search of the terminal rate. By the way, if you said to me, hey, Jim, what's the terminal rate? I would answer truthfully. I would say, I don't know, but neither does Jay Powell. Jay Powell doesn't know what the terminal rate is. He's kind of saying, we'll know it when we see it, but we're not there yet, and we're going to keep going. They have what they call the DOTS, silly name, but the members of the Board of Governors and the Federal Reserve Bank presidents give estimates, or their estimates of unemployment, inflation, growth, and interest rates for the next 3 years, and they put them as dots on a chart, so they call it the dots. And then, Wall Street gets the dots. They do a central tendency and regressions and all this stuff. By the way, one of the top Fed insiders, like practically sits in Jay Powell's lap, has all the way back to Bernanke and Yellen, told me personally, he said, the inside the Fed, they regard the dots as a joke. They're not better than guesses. Their forecasting ability is dismal. You or I would have better forecasts. And they wish they could get out of it, but they don't know how. So that's the truth. But the problem is Wall Street and the financial media and the talking heads on CNBC, they want to talk about the dots, and it does affect market behavior. So even though it's a joke, even though the forecasts are terrible, you have to pay attention because it affects the markets. And if you're affecting the markets, you're on the wrong side, you're going to get run over. So I look at the dots not because I put weight on them as predictive analytic tools, but because the market pays attention, so we have to pay attention. So the dots say that the terminal rate is going to be approximately 5.1%. They're not going to have a 0.1%. So 5.25 is a good estimate. That 5.25 is your best guess as to what the Fed thinks the terminal rate is, because that's what they said in the dots. So we're 4.5 now. So how do you get from 4.5 to 5.25? Well, that's 3 25 basis point hikes. That would be February 1st. The one after that is March 22nd. And the one after that is early May. I'm not sure the exact, May 3rd or 4th. I think it's May 3rd. So you're going to see more rate hikes, 25 basis points each. That's going to get you to 5.25. At that point, they should say, okay, we're at the terminal rate. We'll sit tight and let inflation come down. So that's what Powell's going to do. Here's what the market says. Okay, so that's the Powell plan. We already know it. The market says, hey, inflation's already coming down. Well, it is. That's actually true. Inflation peaked on a year-over-year basis. Monthly report calculated year-over-year was 9.1% in June, but it's come down. Now, 7.1 is still high. Don't get me wrong. Inflation is still high, too high. I buy gas and shop for groceries just like everybody else, so it's still too high. But it has come down from 9.1% to 7.1% in the last 5 months. And so the market says, hey, you did it. You're already there. Inflation's coming down. Why don't you stop? And by the way, you're going to get the memo, maybe in February or sometime soon, you're going to get the message. The economy is going to be slowing down. Inflation is going to be coming down. You're going to hit the pause button early, meaning maybe as early as February, and then you're going to cut rates. This is the famous pivot. Whenever you hear of the Fed pivot, that's when the Fed turns around and starts cutting rates instead of raising them. And that'll be just in time, and growth will slow, but it won't be too bad. And we'll come in for a soft landing. And this is the Goldilocks scenario. So again, typical Wall Street, get the pom-poms out. The Fed's going to cut rates by March, and so buy stocks. That's all Wall Street knows is buy stocks. So that's Wall Street's version. So there's the Powell plan and then Wall Street's version. Here's the reality. There is a chance that we are already at the terminal rate. But the conundrum is inflation coming down because the Fed is still hiking, or is the inflation coming down because they're at the terminal rate? Well, we don't know. It's kind of hard to sort those things out. Powell would say, yeah, it's coming down. I know that, of course, but it's because I'm hiking and I'm going to keep doing it. My view is, no, you actually did it. It's mission accomplished. You just don't know it. You're fighting. You're like the Japanese in the caves fighting 4 years after the end of World War II. I mean, you're still raising rates, and you already got to where you want to go. That means, as usual, they're going to screw it up. They're going to blunder. They're going to go too far, and it's not going to be a mild recession. It's not going to be Goldilocks. In this version, Goldilocks gets eaten by the bears. In other words, you're going to throw this economy into a very deep recession because you're going to go too far, as usual, and you're not going to know it until too late. By the time you realize it's mission accomplished, you will have gone too far, too long. Rates are going to be too high. And it's not going to be a soft landing. Number one, reduce your exposure to equities. If Wall Street's talking up the stock market based on the soft landing Goldilocks scenario, but Powell's going to stick to his guns and raise rates too high, that's going to cause stocks to crash very severely, very suddenly. If the market were adjusting, so yeah, Powell means it, it's going to keep it, we ought to come down a little bit. That would be one thing, but that's not what's happening. The market's trying to rally. Powell's warning people what's going to happen. They're not listening, and it is going to happen. So markets will crash. So lighten up your equity exposure. I'm not saying sell every single stock. There's room for a slice of stocks. I would, for the stock portion of your portfolio, I would look at energy, like, companies like, the obvious names, Chevron, BP, ExxonMobil, Marathon, because they have refining capacity. We're not getting away from oil and natural gas, in my lifetime, probably not in this century. The whole, I got nothing against solar power and windmills, but if you think you can run a modern power grid on that, you know nothing about physics, you know nothing about the baseline power needed to maintain a power grid. You know nothing about the chemicals needed to make batteries for electric vehicles. There's not enough lithium in the world to make more than a small fraction of all the batteries they say they're going to have. Not to mention the fact you use up more energy mining the minerals, the cobalt, the lithium, the copper, and the nickel you need for the batteries than you save having the batteries themselves. They wear out after 8 years. And how much energy and water do you use to do the mining to get the lithium to make the batteries, and why is that good for the environment? So none of it makes sense. It's an ideological crusade by a bunch of elite eggheads who have a hidden agenda, which is about transferring wealth from the northern to southern hemispheres. You have to see through this, what I call the Green New scam. So that means that oil and natural gas have been so beaten down by the Larry Finks of the world that, but we're going to need them. There's no substitute. Those are really good stocks to buy. So I would lighten up on equities overall, but to the extent I had an equity slice, I would look at the energy sector. I would get treasury notes, 10-year notes I like, but if they're a little too volatile, seasoned to taste, you can look at a 2-year note or 5-year note or a 2-year note where you have less volatility. Given the scenario I outlined where there's a severe recession right around the corner, that means interest rates are going to come down a lot. I know everyone's talking about inflation. That's fine, but deflation is right around the corner and no one's looking for it. Interest rates come down a lot. That means there could be huge capital gains on those notes. And of course, they're very high quality from a credit perspective. So 10, 5 or 2-year notes, treasury notes, not junk bonds, the treasury notes in your portfolio. I have a big slice of cash, maybe as much as 30%. People say, I hate cash because it has no yield. Well, first of all, if we have deflation, cash could be your best performing asset because the real value of money goes up, not down. goes down in inflation, but it goes up in deflation. But cash also has embedded optionality, meaning if things are crashing and burning all around you, the person with cash who's not stuck in the wrong asset class can go shopping. You can pick up the bargains. And by the way, the biggest cash hoard in the world right now is probably Warren Buffett. Berkshire Hathaway has $130 billion in cash. Why? Because he sees what I see. He sees what we're talking about. The wreck is coming, and again, you get to go shopping. I like real estate. Not so much commercial real estate. I think it's early, but residential real estate, multifamily housing, farm, other kinds of income-producing real estate. That's a winner. I like gold, but 10%. People say, yeah, Jim Rickards says sell everything, buy gold. I've never said that. I don't think it's a good idea. But 10% slice. Gold and silver, by the way. Silver will, in a real severe crisis or social disorder, a monster box, which is 501 ounce American Silver Eagles, costs, maybe $15,000 or so at the market. That's like, to me, it's like having, batteries and flashlight and water and plywood in a hurricane. You want a monster box around. And that's, by the way, that's real diversification.
Small ebook, big impact. The